Hey guys, Anthony Special here with Hawkeye Traders. Hope you're having a wonderful day. In this video, we are going to be taking a look at the Swiss Franc Futures Market. This is a 5-minute chart, meaning each candle represents 5 minutes of price action. Many would go, well, I'm a Forex trader, and I know that it's really hard to read volume on Forex. Well, guys, listen. The reason the futures market exists is because it's heavily regulated. So if you are trading a Forex pair on perhaps an exchange that we don't necessarily know that the volume is completely accurate because there's so many exchanges that house Forex, I always recommend looking at the futures market for both of the pairs that you are trading. Why? Because here in the United States, they're heavily regulated, which is why I'm a futures trader, okay? I like a well-regulated market. I like a market that has the liquidity I need. It's just the way I trade, all right? I feel very confident in taking those trades because I know what I'm getting, when I'm getting it, why, where, and the whole deal, all right? So I am a huge advocate. If you're trading the Swiss franc US dollar, you should be looking at the Swiss franc and US dollar futures if you're trading the currency pair in the Forex market. I'm just a believer of that, all right? And why am I a believer of that? Well, for a couple of reasons. I am a volume and price action trader, which means I need an accurate assessment of both the volume and the price action. So what we're going to talk about here in this video is identifying not only a reversal, but also a double top in the making. So these are overnight hours. I feel like that's irrelevant because people are trading the Forex market essentially all the time, right? Just because I'm on New York Standard Time doesn't mean that somebody, halfway around the globe isn't trading this market. So I want to take a look here very specifically at this 3 a.m. candle. And when I say 3 a.m., it's 3 a.m. my time, which I realize for those of you watching this probably doesn't apply to most of you, which is totally fine. But look at this super strong buying volume, right? So we get strong buying volume here at 235. Notice how we close, I would say in the top 10 or 15% of the overall candle, okay? That tells me that the buyers are very present, they're very aggressive, and that gives me the reason to believe that continuation is possible. All right, we get two neutral candles here. We get another buying candle. Now, I want you to notice something. Bigger candle closed closer to the top, lower volume. That's a big concern for me. All right, so now I'm starting to think that perhaps the buyers are actually starting to weaken. Okay. So we get another little candle here with some selling, and then we get what we call right here a volume climax. That means that the buyers stepped in one last time, gave it all they have, and that's the end of it, right? Notice how we close roughly at about the 50% range area of the total range of this candle at 3 a.m. So what does that tell me, right? That tells me that in the top portion, the wick of this candle, there's a pretty good chance that if we retest this, it should provide another area or a future area of failure, correct? Right? If the buyers gave it all they had and they were unsuccessful in closing within this area, I would think that when we revisit this area, what's going to happen? Well, probably not going to do as well. So, market falls back. You can see, not super crazy volume here. We get a little strong buying as we try to recover, okay? And boom, we push back in. I want you to notice something here. This last wide bar is what? Unreasonably low volume, okay? I mean, listen, I'm just going to be a little dramatic here just to kind of prove my point, but, I mean, you tell me. Is the volume in the grand scheme of things, since that volume climax occurred, rising or is it falling? I mean, it looks like it's falling to me, and I'm sure most of you would agree with that, and I'm sure if we picked some random 5-year-old and said, hey, is that line going up or down, which direction is it going? Well, it's obvious, right? The overall trend in volume here is depleting, meaning there's a lack there of buying interest, okay? Even the buying surges are significantly lower than the last attempt here. Now, this to me, blindly, I can look at it and go, there's a really, really strong chance that we're going to reverse here, okay? In fact, if I was dialed into this market, if I was in the zone and I saw this happen, I would probably look to try to sell short here on the close of this candle, placing my stop right above it, thinking that we're going to at least correct, all right, before we potentially even revisit the area. And that's what happened, all right? I take these reversals fairly often. If I have a reason to believe that a volume climax has occurred, okay, and the market provides the evidence for me to believe that, right, I'm more often than not willing to try to short that or buy the bottom simply because there's a good chance that a reversal is going to happen, right? And chances are that reversal overall is going to be more significant than the risk that I'm taking. So market pulls back again, push back up. Notice that, again, super low volume here, right? Large candle, close in the top 10%, but what? There's no supporting volume, right? I need to see volume increasing as I'm coming into an area like this, right? In fact, I want to see volume increasing as I go through an area like this. And that didn't happen. And ultimately what ended up transpiring was we formed a double top, okay? Right? And this would be what? This would be something we call the neckline. The neckline is a low between a double top or a high between a double bottom. All right, you can see price breaks down, goes on to continue lower, chopping around, comes back up a little bit, again, fails to take that area, again, sells off. And the market did ultimately what it did. But what did I need to know? Right? I could have approached this in two manners. One, I could have got short here when I saw the volume climax. Okay? Two, I could get short here when I see the approach back into the wick of this candle on what? Significantly lower buying volume. Okay? I mean, if I got short here, I'm not risking a whole bunch, right? As I push in this area, this candle went against me, what? Three ticks? Okay? And then fell back to the neckline for what? 32 ticks? Right? Like that's a 10-to-1 risk reward. Where would my target have been? Well, the neckline. Why? Because that's where price came from. Right? So a 10-to-1 risk reward. To me, I think that makes a great deal of sense, right? And I'm sure most of you would agree that that's probably not a terrible risk reward ratio. So what I'd like to do is dive a little deeper into understanding this relationship between volume and price action with you, meaning you, okay? I'm going to provide a link below this video and ask you to click on it. Join me inside a training webinar. We're going to dive a little deeper into this theory. I want to share some examples with you. I want to share with you some success Hawkeye Traders have had by understanding this relationship that most people just simply don't, right? I mean, I'll be frank. Most people are looking for some indicator to do it for them. Okay? And I can tell you that you're not going to find it. And I'm sorry, all right? I'm not trying to diminish anybody's product that they provide or indicator or software they provide, because every unique approach to the market requires an understanding of one thing. The one thing that we're going to teach you, the relationship between volume and price action. Okay? I'd like to get these printing on your charting platform. It works on TradeStation, TradingView, NinjaTrader, and MetaTrader. I'd like to grant you access to the Hawkeye Volume Mastery Series, where you can, at your own pace, dive into one video after another, teaching you the relationship between volume and price action. Okay? And once you have these indicators populating, you will get the unique color of which the aggressive party in each candle, right, is printing here. All right, so we had aggressive buyers, aggressive sellers, okay? Because that's what moves the market, guys, right? There's never an imbalance of buyers and sellers. For every person that buys something, somebody has to be willing to sell something. Right? That's the way the market works. At the end of the day, it's a zero-sum game. But whoever is willing to be more aggressive is going to be the party that moves the market in their favor. So if we have aggressive buying, we're going to keep going higher. If we have aggressive selling, we're going to keep going lower. If we have just somewhat of a balance, the market's going to do the chop, right? That's what I call it. I call it the chop, right? And we don't go anywhere, and that's okay. But I want to teach this to you in this training webinar. I want to help you understand it. Because guys, I am just like you, right? I came into the trading space having very little to no knowledge of what I needed to understand in order to do this job. I spent tens of thousands of dollars on indicators and software thinking that this thing is going to just do it for me. I'm going to print money and life's going to be great. Well, that didn't happen, right? It wasn't until I found Hawkeye, and I'm a paying customer, all right? I was never reimbursed for what I paid, right, for the software myself. Right? I bought it, my own hard-earned money. I put it to work. I built a trade plan around it, and I went on to take very significant, very successful trades, right? I was able to grow as a trader because I needed this foundation that nobody told me I needed, right? They were just trying to sell me something, right? So I'm trying to help you learn what I needed to learn, and that was understanding the relationship between volume and price action. I have people approach me all the time. Anthony, I want to learn to trade. Great. Start studying the relationship between volume and price action before you even open a brokerage account, because that is something you're going to need to master. Well, Hawkeye makes it easy, right? Because we print the colors of the aggressor in the market in any given period of time. Whether it's day trading, swing trading, position trading, stocks, futures, Forex, cryptocurrencies, it doesn't matter, right? All markets move based on who the aggressor is at any given point in time. And we want to help you understand that by allowing our software to print the aggressor on your screen. If I remove the drawings, what am I left with? Hawkeye volume, the radar dots, Hawkeye price action, right? So the candles print, right? Who's the aggressor at any given point in time, right? These purple bars or these magenta bars are called wide bars. They tell me, without me having to do a calculation, that, hey, based on the prior X amount of bars, we see that the market is moving in some fashion more aggressively by a particular percentage. I'm not going to break all that down because it would just take too much time, but that's ultimately what it's doing. It's signaling me, hey, Mr. Trader, Mrs. Trader, you need to be paying attention because something out of the ordinary is happening. And more often than not, when something out of the ordinary happens, something extraordinary is typically follows. And that extraordinary is the opportunity that you get to capitalize on as the trader. So again, I invite you to head below this video, click on the link for the training webinar, join me, let me dive deeper into this concept. Let's get the indicators on your charting platform. Let's get you access to the Hawkeye Volume Mastery Series. Let's simplify your trading and amplify it by understanding volume and price action. Guys, thanks so much for being here today. God bless, and I will see you in the next video.